This video is a response to questions about the interpretation of Morgan Housel's The Psychology of Money by several friends. Below are our responses for reference. Question 1. Does the performance of Renaissance technologies suggest that the stock market does have patterns, but these patterns are complex and difficult for the average person to grasp? Answer. Renaissance Technologies, or Renaissance for short, is currently the most successful hedge fund. Its average growth rate from 1988 to 2018 was an astonishing 66%, far exceeding common perceptions of the stock trading industry. How did they achieve this? The algorithms used by Renaissance are strictly confidential, and employees sign non-disclosure agreements. Even today, no one precisely knows their specific methods. Renaissance stopped accepting external funds in the 1990s and traded only with its own capital. Over the years, various speculations have emerged based on the limited information available. What we know so far is, Renaissance Technologies was founded in 1982 by a mathematician named James Simons, who was previously involved in cryptography. The company initially hired experts in cryptography, suggesting the possible application of code-breaking techniques to financial markets. In the 1990s, Simons recruited two computer scientists from IBM specializing in speech recognition, which essentially involves artificial intelligence and big data analysis. Renaissance never hires individuals with traditional finance backgrounds. Instead, they recruit mathematicians and physicists, known as quants or quantitative analysts. Based on available information, it is speculated that Renaissance relies heavily on artificial intelligence for market data analysis, similar to the principles behind AlphaGo in the field of philosophy. Renaissance has its high-performance computing lab, extensively using programmers to assist scientists, and Simons even hired two high-performance computing experts from Yale University. According to the book More Money Than God published by The Economist in 2010, Renaissance's profit-making strategy likely involves high-frequency trading. What is high-frequency trading? Imagine, in traditional stock trading, it takes at least a minute from observing a market situation to placing an order on the computer. High-frequency trading, however, occurs within fractions of a second, as fast as 64 millionths of a second. To gain this time advantage, Wall Street has established specialized information transmission networks. Decisions in high-frequency trading are entirely made by artificial intelligence based on algorithms, with no human involvement in specific decisions. These companies complete countless trades each day, focusing on the statistical advantage accumulated from numerous transactions rather than the outcome of individual trades. High-frequency trading has several benefits, with two essential ones that are easily understood. Rapid digestion of new information. In a typical scenario, it takes about 15 minutes for a news event to be reflected in stock prices. High-frequency traders, using artificial intelligence, can monitor, read, understand, analyze, and execute trades in a matter of milliseconds or even less, making the news outdated for retail investors who haven't heard about it yet. Statistical trends in short-term stock price fluctuations. This involves recognizing patterns in the short-term volatility of stock prices. In essence, Renaissance views stock trading as an information problem. The company's advantage lies in the speed of its operations, compared to the market's equilibrium return. This advantage is manifested in pattern recognition. For example, in a football analogy, betting on a game's outcome is like high-frequency trading, slowed down 64 million times. It involves buying and selling every millionth of a second. If your reaction is slower than the game's progress, it seems like football has no patterns. If your reaction is much faster, the game becomes a predictable event for you. Of course, others are doing the same thing. High-frequency trading in the stock market isn't equivalent to watching a game in slow motion. It's more like each high-frequency trader operates at different speeds, and the game itself is high-frequency. Your advantage lies in ensuring that you can judge the on-field situation faster and more accurately than other high-frequency traders. Where does this advantage come from? It comes from pattern recognition in the situation. If you only realize the forward has shot after the fact, it's already too late. Your advantage lies in, for example, assessing the probability of a successful shot from a particular pass and the likelihood of that shot turning into a goal. You need a high-level judgment of all situations on the field. This is precisely what big data analysis, machine learning, and similar technologies provide. The specific algorithms are confidential because you don't want others to figure them out before you do. The algorithms must also change over time because today's football games may be very different from those 10 or even 2 years ago, requiring constant updates. However, it all boils down to an algorithmic competition. Renaissance doesn't care about economics or what happens off the field. Their focus is solely on identifying short-term trends from publicly available trading information. In essence, Renaissance turned stock trading into an information problem, much like playing Go. All the information is on the board, as long as the information's changes are not entirely random and have even a slight pattern, they can capitalize on it. And indeed, markets tend to be generally balanced, though never absolutely balanced, providing an opportunity for such operations. We can even imagine an extreme scenario. If I know the trading habits of every company in the market, just as I know the technical styles of every player on the field, then facing this situation, I can anticipate how they'll react before anyone else does. I can make strategic moves ahead of time. Does this not guarantee a win? It's not a question of profit and loss, as it doesn't involve rigidly adhering to a risk style. However, high-frequency trading does have its flaws. Instances have occurred where algorithms engaging in high-frequency trading caused inexplicable market fluctuations. The situation resembles an arms race. Today, you have a functioning new algorithm, and you make money. After a while, the algorithm may become obsolete, and by that time, I've discovered a new algorithm, putting you in a bind. However, companies like Renaissance, by leading and growing, offering the best conditions to accumulate the most talented individuals, can maintain a lasting advantage in algorithms. Question 2. In the context of primary and secondary education, where only good students seem to thrive, and there's limited time and energy for diverse exploration, how can we ensure that good students maintain their interest or impulsiveness for exploration? Answer. Choices depend on individual priorities. Not everyone can explore everything, and the key is to focus on one's preferred domain, experiment within that domain, select the best outcomes, and then concentrate on those successes. It's a cycle of focus, experimentation, and renewed focus, which can be repeated as needed. The principle of experimentation should be bold beginnings, ruthless endings. Just like reading books or watching movies, if something doesn't capture your interest quickly, it's fine to abandon it. The critical aspect is to avoid being too passive or going along with the flow. Many students are pressured to attend various extracurricular classes without actively exploring their interests. This contradicts the purpose of exploration. Forcing children into extensive, time-consuming activities with limited meaning is counterproductive. Liberation from such activities would allow children more freedom. Question 3. If we don't personally delve into value investing but replicate Buffett's approach, does it save time and still qualify as value investing? Answer. A simple way to replicate Buffett's approach is to invest money in Berkshire Hathaway, allowing him to manage your investments. However, personally mimicking Buffett's actions is impractical. Buffett doesn't announce his stock purchases beforehand, and your buying and selling prices would likely differ from his. Even if perfectly replicable, mimicking Buffett's approach might not be advisable. Investment goals and psychological needs vary among individuals. Are you investing for retirement in 40 years, or do you plan to retire in 5? Is your focus short-term or long-term? Are you casually investing or putting your entire savings at stake? Buffett's strategy may not suit everyone. For those unwilling to delve deeply into investment strategies, investing in an index fund is a more straightforward option. Over the past 5 years, the performance of Berkshire Hathaway, the Dow Jones, and the S&P 500 has been almost identical. While Buffett's pre-2020 achievements were impressive, index funds offer a hassle-free alternative with consistent results.
If you feel there is value in this, please like, subscribe to this channel, and leave your thoughts or suggestions in the comments section. Let's grow together and read more good books.